Hi, and welcome back to another section with us on our accounting discussion today. So, throughout the discussion, we have been looking out for how transactions occurred and how we record them in the books of the account. We have been looking out for how to even enter transactions in the books of the account. But today, we want to learn how these transactions came to effect. Then we're able to enter them in the transactions or able to enter them in the books of the account. So we want to know where these transactions actually originated from and why we also entered them in the ledgers or in the books of account. So as part of our lesson today, we are going to learn what we call the day books of account that are pivotal when it comes to recording of business transactions. So we are talking about the day books. The day books, others may call it the books of what? Prime entry or the subsidiary books of what? An account. So what are these day books that we are trying to talk about here? So when we say day books, as always, day books, we are talking about what? The books in which transactions are firstly what? Recorded. The day books are books in which transactions are firstly recorded. So as part of the business transactions, we want to know where these transactions actually originated from and their effect in the recording of what? The ledgers or in the accounts. So that is the day books. So under the day books, we are going to discuss a number of day books here. We are going to focus on, based on the school of thought, we are going to focus on just the 7 day books that we use in business world activities. So what is a sales day book? As always, when it comes to recording of transactions, there should be what? A source document that will be able to help us to record this in these books. So we are going to discuss them in line with their source document. When we say source document, they are documents which help us to be able to record transactions in these books. So others might define it as what? A documentary proof. We'll say a documentary what? Proof. A documentary proof that transaction has what? Occurred. So for instance, if I have a receipt, I went to bank to pay for my school fees. For instance, the bank will give me a receipt. That receipt is what we call what? The source document. So when I bring it back to the business, I will look at that source document and make records in the books. That is the idea about source document. So we are going to discuss them in line with that. So what is sales day book or sales day book in that case? When we say sales day book, a sales day book is a book in which we record what? Credit what? Sales transactions. So here we are talking about credit sales transactions. Credit sales. It's a book used to record what? Credit sales. What do you mean by credit sales? For instance, if I am the business and then I sell something to you on credit, because you are not paying for it at that time, we call it what? A credit what? Sales. Right? That is a credit sale. Because at the end of the day, when I sold that item to you, you're not paying it at that point in time. You come back and pay it later. We refer to said transaction as what? Credit sales. And before we can record anything in the sales day book, there should be what we call a sales invoice. So for credit sales, the source document used for it is called what? A sales invoice. So sales invoice. That's a source document used for recording of transactions in the sales day book. Because here we are talking about credit sales. Any sales which we engage without receiving cash immediately, we call it what? Credit sales. And such transaction will be entered in the sales day book. So the sales invoice will give us information about the quantity of the item that we sold, the price, the units, and a lot of things that will be factored in the sales invoice will be recorded in the sales day book. So let's take note of that. When it comes to the purchases day book, it's an opposite to the sales day book. Whilst the sales day book deals record with credit sales, the purchase day will also record what? Credit purchases. So whilst the sales day book records the credit sales that are used or any credit transaction that occur in the business, the purchases they will also record or credit purchases. What do you mean by credit purchases? This happens where the business receive an item on credit from suppliers. For instance, let's say we engage in, let's say, buying of toffees, and then from our suppliers, they supply us with a lot of toffees, but we didn't pay it as at that time. This is what we call what? A credit purchases, because we have received it on credit. And as such, for us to record said transaction in the business, we are going to use a book called what? the purchases what daybook. But before even we can even record this transaction in the purchase daybook, we're supposed to have a document. When we were talking about the sales daybook, we said that it's what a sales invoice. So what do you think here is going to be for the sales document? It's going to be what purchases what invoice. So we are going to have purchases what invoice, because here it was on credit what sales, and so therefore when it comes to purchases to, we have purchases invoice. So it is a purchase invoice that helps us to be able to record credit purchases in the purchase what daybook. So let's take note of that. So a quick summary: sales daybook record credit sales, being supported by a sales document called what sales invoice. But when it comes to credit purchases to or purchases to, it also record what all credit purchases, being supported by what a purchases invoice. So let's take note about that. Then back to the returns invoice, we also call it sales returns. Sales returns. Sales returns. What is sales returns? If you remember, when we were talking about the sales daybook, we said sales daybook record what credit sales, or credit what sales, being supported by a source document called sales invoice. But what happens if, let's say, we sold an item to a customer, right? And at a certain point, the customer is not satisfied by the item that we sold, maybe possibly because the item that we sold to the customer, it didn't meet his or her preference. It was, out of quality, right? Or was, let's say, broken, or there was some fault in it. And as part of the business policy, if we sold an item to a customer, the customer has a right to return the goods back to the business. Then he may return it back to the business, right? So when it happens like that, then we are saying that we have what sales returns, also called return invoice. Because here, the item that we sold to that customer, he wasn't happy with it. So the satisfaction was what very low. So as such, he returned that item to the business. Any transactions that occur as a result of all returns from customers from the item you sold to them on credit that they return back to the business, a book called return invoice daybook or sales return will be used to record such transaction. I hope you are following that. So here is coming from the sales what daybook, because here we sold an item to them on credit. And later on, we realized that they didn't accept the goods that we sold to them. They were not satisfied with it, maybe because it was, there was some fault in it. It didn't meet their preference. The good that they want, it didn't satisfy them, so they return it. So when they return it, in the business, before we can get any item of returns to be recorded in our book, we're supposed to use what we call a return invoice daybook or sales returns. And here, it's pretty simple. When it comes to the source document that we use to record return invoice transactions or sales returns, it comes in two forms. We have what we call the debit note or the credit note. It's in two forms. When it comes to the return invoice, if it is the customer who is the first to issue the note, the customer is going to issue a note called the debit note. It is telling the business that, hey, I've returned the goods, and so therefore the business is supposed to receive such a goods, and the business account is supposed to be debited. The business account is supposed to be debited, in a sense that when we bring this into this daybook, there's an account called return invoice account from the return invoice daybook or the sales returns. It is that account that we're going to use to record the returns that the customer brought in the form of the goods. And that's going to be recorded at the debit side of the return invoice account. And then to the customer, we are going to credit the customer, which is going to be on the left-hand side of the customer's account. So if the customer is the one issuing the note, he's going to issue a note called a debit note. So we say debit note issued. Debit note issued by the customer in support with the returns of the goods that he returned to the business, which is going to be recorded in the debit side of the return invoice account. And then to the customer account, you're going to be credited it. But if the business is the one issuing the note, the business is going to issue a note called a credit note, telling the customer that your account has been credited with the amount of goods that you return to the business. So that is the idea when it comes to the return invoice or the sales returns. So it is either debit note issued by the customer in support of the returns that he made back to the business, or credit note given, right, by the business in support of the return, telling the customer that your account has been credited with the goods that you return back to the business. So let's take note of that. The opposite is also very true. When it comes to return outwards, we are talking about what? The business, rather returning the goods from its premises to the suppliers. That one also has its effect or root effect from what? The purchases. If you remember, when we're talking about purchases, we said that here the business actually receives supplies of goods on credit without paying them at that spot. But if at a certain point we are not satisfied with the item that we receive from our suppliers because of grade, the quality, the type, then we have the right to return that goods back to you, the supplier. And in returning it, the document that you support for it or the book that is used to record such return supposed to what? Return outward. That means it is going what? Out. Hence, return outwards. But if it is coming in, we say return inward. You see that? So here too, the same effect. We have debit note as a source document or credit what? Note. Debit note or credit what? Note that we use to what? Take into effect. So let's see how it goes with the debit note and credit as a source document to be recorded in the books of the account. So now, if the business is the one issuing the note to the suppliers, saying that we are returning the goods that you sold to us on credit for which we are not satisfied with it, the business is going to issue what we call a debit note issued. Debit note issued, saying that we have returned the goods to you, the supplier, and so therefore you are the one receiving the goods, because the double entry principle says that we debit the receiver and we credit the giver. So you are the one receiving. You are going to debit your account as a supplier, and then we credit the business account. So if the business is the one issuing the note, going to issue a debit note in support of what? The returns outwards. But if it's a supplier who is first issuing the note, going to issue what we call what? A credit note, saying that the business account is supposed to be credited with the amount of goods that we return back to that supplier. So we'll credit the business account and then we'll debit the supplier's what? Account. An account called return outwards is going to be used to record all the returns that the business returned from its premises to the supplier. Because of maybe quality, type, grade, non-satisfaction will be factored in the return outwards account. And that is the idea about the return outwards. So a quick summary: when it comes to return inwards and return outwards, return inwards is coming from the business customers back to the business. But when it comes to return outwards too, it can be that the business is the one issuing the debit note to the supplier, saying that your account has been debited with the goods we've returned, or the supplier issuing a credit note saying that our account has been credited with the goods that we return. Because the double entry says that we credit the giver and then we debit the receiver. So that is the idea about the two: return inwards, return outwards. So let's take note of that. Then back to the general proper or the general journal. Others might also call it general proper or general journal. When we talk about the general proper, here is very simple. It records all transactions which we cannot record in this four, including the cash book and then the petty cash book. Any other transaction at all which we cannot record in this, that, and including the cash book and the petty cash book, will be recorded in the general proper. For example, when we talk about how we correct an account when there are errors, correction of what? Errors. Correction of errors will be recorded in the general proper. Bad debt. Bad debt. Somebody may say bad debt will also be recorded in the general proper. For example, when we say bad debt is where at a certain point the business sold an item to a customer, but maybe some possible reasons the customer will not be able to pay that amount as at the time we want it. Said that we declared it as what? Bad. We cannot recover at that point that we want such money. So we'll call it what? A bad debt. Right? So that is the idea about bad debt. It can be that the customer is out of business, he is insane, he is in bankrupt, or any other reasons that will make it impossible for the customer to pay the debt for us to receive as part of the cash we're supposed to receive for the period. We'll call it as what? Bad debt. And we can even talk about sales of fixed assets on credit. Fixed assets on credit and others that we can think of will be recorded in the general proper. So most of the times, the general proper records items of in-person. When we say in-person's accounts are what we called real accounts. Okay, and then the nominal account. We'll talk about some of these issues going forward. But just a quick summary. Note that general proper records only items which you cannot record in the four above, including the cash book and then the petty cash book. So let's take note of that. All right. So that is the idea about the general proper. How about the cash book and then the petty cash book? When we say a cash book is very simple. Cash book. This means that this book record what? Cash and cash what? Alone, right? So here we are talking about what? Recording of what? Payment and receipt in terms of what? Cash and check only. You know that check are used in what? Banks. So in some tests they will say that this they will use to record what? Cash and what? Bank. But in a more better way, we will say that cash will use to record items of payment and receipt in terms of what? Cash and what? Check. And when it comes to cash, we have various types of cash. We have single column cash book, double column cash book, and triple column. We'll discuss some of these things when we are looking at them individually. So let's take note of that. Then for the cash book too, we have a source document. I didn't talk about that though. For example, when we are talking about issue about receipt, bank statement, then we can talk about what again? Paying slip. We can also talk about check counter for. All these can be a source document for cash book. When we say receipt, let's have a classical example here. Let's say you went to bank to make a deposit or withdrawal. All things being equal, we expect that the bank will give you a receipt. So when you bring that receipt to the business, you come and tell us that this is the amount that you deposited, this is the amount that you withdrawn, so that we can use that as a basis to record such information in the cash book. So on that basis, the receipt here becomes a source to the information in the cash book. Hence, receipt. So cash receipt is there. Bank statement is also very true. When it comes to preparation of what? The financial statement, we mostly want to know how much amount has been entered in our account and how much has been withdrawn and any other thing that you have received. Bank statement should also help us to be able to make such a record, because with the bank statement, we're also going to help us to know how much you have deposited, because amount that we deposited on the bank is supposed to have the same reflection in the cash book. So the bank statement will serve as a cross check in our cash book so that we know that, okay, we have, say, $10,000 in our account, right? So on the cash book, we're supposed to have the same what? $10,000. So the bank statement will serve as what? A source document for us to make entries in the cash book. Then the paying slip, most of the time we use this in, let's say for example, paying of school fees or paying of any other thing at all. When you go to the bank, they will ask you go to the counter to pick some of these documents, and within that we even have a carbon copy. When you write the amount you want to pay, deposit, it will have a reflection of that carbon copy. That document, we call it paying slip for making payments and for deposits in the bank in that case. And then the check counterfoil to have a reflection with the paying slip. It's like a carbon copy. As you write any amount of check, it's part of the checkbook that we're going to give to you as a customer. So when you write any amount to be deposited or withdrawn, it gives a copy of what you have written, whether 10,000, whether any amount that you're going to write, any information you're going to write on the check is going to have a copy on that carbon or paper. We call that as what? Check counterfoil. And we can also use that as a basis to record transactions in the cash book. So let's take note of. We have a lot, but at least these four will guide you on how to make some entries in the cash book when it comes to the transactions on cash. Then lastly, we have for the petty cash book. I will leave this for you to drop in the comment section. What do you think is petty cash book? I'll read your answers in that line. Petty cash. The name is what? Petty cash book. So thank you for watching. This is where we'll end our presentation. So in our next session, we are going to take them individually to take a question on how these transactions are recorded in these books of accounts. So thank you for watching. I'll see you in the section. Bye.